Hello everyone. Today I'm going to talk about financial markets that are regulated by the Reserve Bank of India. The Reserve Bank derives statutory powers to regulate market segments from specific provisions of the Reserve Bank of India Act 1934. The prudential guidelines issued by the eligible market participants form the broad regulatory framework for government securities, money market, and interest rate derivatives. The core objective of the Reserve Bank's regulations for financial markets is to develop a safe and stable market which provides appropriate products for trading as well as risk management. As part of this approach, it has sought to remove structural rigidities for better price discovery and increasing both the depth and width of the financial markets. Efforts are on to develop and strengthen interlinkages between market segments, fostering competition, increasing menu of choices through innovations in products and market practices. Regulatorily, legal, institutional, and technological infrastructure is also being strengthened for orderly market activity. As you can see on the slide, major market segments under the regulatory ambit of the Reserve Bank of India are interest rate markets, including government securities market and money markets, foreign exchange markets, and then derivatives that are based on interest rates, prices, repo rates, foreign exchange rates, and as well as credit derivatives. Let's move on to government securities market. The government securities market, which trades securities issued by central and state governments, has seen significant growth in the last 2 decades. It has a sizable primary market and an active secondary market. Trading largely takes place on the negotiated deal system order matching and anonymous order matching trading platform. All the secondary market transactions in government securities are settled through a central counterparty mechanism under delivery versus payment mode. Multilateral netting is achieved through single fund settlement obligation for each member for a particular settlement date. The settlement is achieved in the RTGS form or the real time gross settlement or the RTGS or current account maintained by the member in the Reserve Bank. Moving on to call money markets, there are two types. An uncollateralized call money market is restricted to banks and primary dealers subject to prudential limits. The collateralized segments include collateralized borrowing and lending facilities and market repo transactions between banks and financial institutions. The money market also includes commercial paper issuances by corporates, PDs, and financial institutions, and certificates of deposits issued by banks to institutional investors. Detailed guidelines on each of segment of the money market are available on the RBI website under money market section, and it's a pretty big section that each and everyone should go ahead and look at. The second type of money markets is the collateralized segment, which includes collateralized borrowing and lending facilities that I talked about beforehand. So there are in total two called money types of money markets that the RBI regulates. Now we'll move on to the foreign exchange market. The foreign exchange market, the Foreign Exchange Management Act 1999 or Act 42 of 1999, better known as FEMA 1999, provides statutory framework for the regulation of foreign exchange derivatives contracts. Residents can hedge their foreign exchange exposures through various products such as forward contracts, options involving rupee and foreign currencies, currency swaps, and cost reduction option structures in the OTC market. Foreign investors can also hedge their investments in equity or debt in India through forwards and options. In addition, trading within specified position limits is permitted on exchange traded currency futures in four currency pairs and in USD for currency options. Residents are also permitted to hedge their commodity price risk as per specific guidelines in the overseas OTC markets and exchanges. OTC here means over the counter markets. Over the years, the foreign exchange spot as well as forward market has expanded quite significantly. Moving on to derivatives, In the OTC interest rate derivatives segment, interest rate swaps and forward rate agreements are permitted on various benchmarks where banks and primary dealers take hedging and trading positions. Other regulated entities like insurance companies, mutual funds, non banking finance companies can participate in IRD for the purpose of hedging. The activity in IRS market has shown impressive growth, with the average daily interbank trading volume in notional principal rupees at 88 billion rupees in the financial year 2014-15. In addition, there are exchange traded fund rate futures which are also open to foreign portfolio investors that are growing significantly. That's all for today's video and today's presentation. Thank you so much for watching. Thank you. Bye bye.